My name is Heather Orillion, and I'm doing this financial analysis on Apple. Apple is a technology company that designs, develops, and sells consumer electronics, computer software, and online services. For this financial analysis, I used Bloomberg in order to analyze the company. In order to decide if I would give a short-term loan to Apple, I looked at its quick, cash, and current ratio. A current ratio measures a company's ability to pay short-term and long-term obligations. A ratio under 1 indicates that the liabilities are greater than the assets, meaning that the company would be unable to pay off its obligations. And a high current ratio over 3 could indicate that a company isn't using the assets efficiently. The cash ratio measures the amount of cash a company has over current liabilities, and the quick ratio measures the ability of the company to pay its current liabilities. Apple's current ratio is not below 0 or above 3, so I would consider giving a short-term loan to Apple. Long-term ratios are intended to show firms' long-run ability to meet its obligations. For Apple, I looked at the financial leverage ratio called equity multiplier. The equity multiplier measures the amount of a firm's assets that are financed by its shareholders by comparing total assets with total shareholders' equity. A high equity multiplier indicates that a larger portion of asset financing is done through debt. Low multiplier ratios are more favorable because companies with lower ratios are less dependent on debt financing. Apple's equity multiplier has increased from 1.54 in 2010 to 1.87 in 2014. The higher the equity multiplier, the more debt, and Apple's equity multiplier continues to rise, suggesting that Apple continues to have more debt. In order to decide if I should invest in Apple, I looked at return on assets, return on equity, and price-earnings ratio. Return on assets is a measure of profit per dollar of assets. Return on equity measures how well stockholders fared during the year, and the price-earnings ratio measures how much investors are willing to pay per dollar of current earnings. Apple's ROE is high, which suggests that the company is efficiently generating profits using shareholders' equity, and Apple's ROA is high, which reveals how much profit a company is earning for each dollar of its assets. Apple's price-earnings ratio is somewhat low, which means that the market does not expect growth from the company. The price-earnings ratio is a reflection of the market's optimism when it comes to a company's growth. Even though the price-earnings ratio is low, I would consider investing in Apple. Their ROE and ROA is high, which suggests that Apple is efficiently generating profits. For this financial analysis of Apple, I determined that I would want to give a short-term loan and I would want to invest in this company. For the long-term loan, I would need to look at several other ratios using Bloomberg, but based on the equity multiplier, I would not want to give a long-term loan to Apple because it seems like the debt is continuing to increase.